The Fed's 2% inflation target has been one of the surest things in markets for a very long time. But my guest today thinks that's all about to change.
Maybe 3 is the new 2 in terms of inflation. And by some metrics, if you take longer term measures of inflation, we're closer to 3.5.
Jurrien is Director of Global Macro at Fidelity. Fidelity, with 13 trillion in assets under management, an 80-year-old company with 50 million customers. Suffice to say, what he thinks and what the firm does matters. In this episode of the Finimize podcast, we discuss where US inflation will ultimately land, whether the yield curve matters anymore, and a huge amount more. So strap in, this is a good one. Jurrien Timmer, welcome to the Finimize podcast.
Nice to see you.
Fantastic. So let's dive in. There's so much going on in markets right now. We've just seen signs that inflation might be cooling in the US. We've seen the job market starting to soften a little bit, weaker than expected retail sales. The $1 million question right now is, what is the Fed going to do and when? So I'd love to just start with that big question. What's your expectation here?
So the Fed clearly has a bias to ease, and it is rightfully erring on the side of maybe waiting a little bit longer than it wants to, rather than cutting now and having to take back those cuts later. I mean, that was a policy error that the Fed made all the way back in 1966, that was at the beginning of the Great Inflation, and it was a premature pivot back then, there was a price to be paid for it. So in an era today of fiscal dominance, where deficits are large and persistent like they were back then, I think the Fed is rightfully kind of leaning against that a little bit and waiting maybe longer than it intended to when it started to release its sort of expected rate cuts back last December at its FOMC meeting. And the good news is that the economy doesn't really seem to need rate cuts, and the stock market doesn't seem to need rate cuts the way it did last year, because last year earnings were contracting, excuse me, and right now earnings are growing. The forward estimate's growing by about 12%. So when you plug in, interest rates and earnings into a discounted cash flow model, when the numerator of that model is growing, meaning earnings are growing, the market is less dependent on rate cuts. It doesn't mean it wouldn't welcome them, of course, but it's less dependent on them. And that's why the market has been actually pretty resilient this year, despite the fact that the 7 rate cuts that were expected by the market at the beginning of the year are reducing down to maybe 1 or 2. And so when I think about what is the Fed solving for, Fed's at 5 3/8 right now on the Fed funds rate. Inflation is proving to be somewhat sticky, around 3-ish%. I mean, the latest CPI number did come in more favorably, but still, maybe 3 is the new 2 in terms of inflation. And by some metrics, if you take longer term measures of inflation, we're closer to 3.5. And so when you think about, okay, if that's the new sort of run rate for inflation, and we're in a soft landing, which by all measures we seem to be, then the Fed should be targeting a real rate of maybe, let's say, +1. And so then you get to 4.5% as a neutral rate. So the Fed at 5 3/8 is above that, so it's restrictive, but it's not restrictive by such a wide margin that every second that the Fed isn't cutting rates, there's the risk of the whole thing, imploding. And so I think that gives the Fed a little bit of margin or room just to kind of say, okay, you know what, we have a bias to ease. We'll probably ease a couple of times, maybe not this year, maybe once this year, maybe twice, who knows, a couple more times in 2025 to get closer to neutral, because inflation has gone from 9 to 3 or 3.5, and that obviously is an improvement, although for the typical consumer who is paying 20% more for stuff than he or she did 4 years ago, that maybe is not much of a solace, but still the rate of improvement, the rate of change has improved, and that should allow the Fed to go back towards neutral, which is probably 100 basis points below where they are now.
Super, super interesting, Jurrien. I think we could spend the entire podcast unpacking everything you just said there. But I do want to get onto other topics. But before we do that, there's two follow-up questions I think we should spend a bit of time on. So one, you said, if you suggested maybe the new normal for inflation is 3% or thereabouts. So the question there is, what happens if the Fed comes out and says, actually, look, we're not targeting 2% anymore. We think 3% is the new normal. Do you think they will say that? Is there a world in which they say that in a roundabout way? And then the second question, and sorry, just to load them on, but the second question, you mentioned a couple of times, look, the economy doesn't need rate cuts right now. And the data certainly supports that. Does the yield curve matter then in that context? Because we're well on our way to a soft landing. The economy doesn't need rate cuts in the way that theory might suggest it would. We've had an inverted yield curve for longer than I can remember now. Does it matter anymore?
Yeah, it's always dangerous words to say. This time is different. But let me start with the first one. Okay. So the Fed has had a target of 2%, of course, for a long, long time, and until the pandemic, the Fed chronically underachieved that target, which in a way made policy somewhat simple. Not to say that Fed policy is ever simple, but whenever there was a shock to the system, meaning the unemployment rate went up, the Fed could just completely focus on that and not worry so much about inflation. And that's why we would go to the zero lower bound and QE would get unleashed, and the Fed didn't really have to weigh both mandates, right? It has a mandate of full employment and 2% inflation. Now, of course, inflation is elevated. It's around 3.5. I do think that 3 is the new 2, and that it's going to be hard to get that last mile in from 3 to 2. And to your question, I think it's not implausible that the Fed at some point will tolerate something higher than 2. And in a way, before the pandemic, the Fed had introduced what we call AIT, average inflation targeting, by saying, we're not going to worry the second the inflation rate goes back up to 2. We're going to let the average go to 2, which means it can overshoot 2. And so the Fed was, maybe with the luxury of not having to worry about inflation, was showing some flexibility in that sense. So I don't think the Fed will just come out after an FOMC meeting, say, hey, guess what? We're now targeting 3. But you might see a bunch of white papers being produced and maybe some Jackson Hole speeches. And so I don't think it will be a sudden thing, but maybe the Fed will introduce a band. And, when you think about an economy that has a lot of debt, as the U.S. does, as well as other parts of the world, usually you try to grow out of that debt. That's what we did after World War II. Maybe we can do it again. Maybe AI will will create that promise, but demographically, it's going to be harder to do that. And typically when you have debt and you can't grow your way out, and if austerity is not politically feasible or even possible, given the unfunded liabilities that the U.S. has, some inflation actually can be seen as productive, maybe not for you and me as consumers, but for a government that has a lot of debt. So it certainly wouldn't surprise me that 3 will be tolerated, even if it's not explicitly targeted as a new policy target.
My 2 cents on that, and it's a much smaller 2 cents than your own, but it's that if we weren't in an election year in the US, this would be a much more prominent conversational talking point, and actually it might be something that early 2025, if we're still kicking around 3%, that becomes that band you talked about becomes a more prominent topic. But
Yeah, and you mentioned the election, of course, and the Fed's independence is always kind of an existential question. And it's interesting.
yes,
I've studied the Federal Reserve all the way back to its inception in 1913, and especially during the 40s, which was a period of fiscal dominance and financial repression on top of that, and then again the 70s, and even when after the Fed became independent in 1951, there was a lot of meddling going on by
yeah,
the administrations in the 60s, whether it was Kennedy or Nixon. Like this is not a partisan thing, and so governments want the Fed, to be supportive of what they're doing. And so I'm not making any predictions here, but when you think about inflation targets and tolerating a higher inflation rate if that means full employment, right? Because again, the two mandates have to be weighed. That's a tricky question, and the election, can be relevant in that sense. And the whole story of fiscal spending and the persistent deficits that we have, that's actually less of a topic this year than it might have been
yeah,
in the past. And I think one of the reasons is that everybody in Washington likes to spend money. It's not funny, but and also not much of the budget is really discretionary, right? When you add up Social Security, Medicare, Medicaid, defense, and debt
yeah.
service, there's really not that much left.
There's not much left at all.
Yeah. But on your question of the yield curve, this is really a great question. And again, we don't want to say it's different this time. The yield curve has been, it's been kind of perfect as an indicator in one way, in that it has generally preceded a recession, with the exception of 1966, although you could argue that was a matter of timing rather than giving a false positive signal. But the variability of when it kicks in, of course, is frustratingly disperse, right?
Yeah,
it can a bear market or recession can happen the very second the yield curve inverts, or it can happen 2 years later. And so I think there's always some mitigating circumstances, and I think especially during this cycle, that is very much the case, right? So if we think about what a yield curve
yeah,
typically means, it means that the cost of funding for banks goes up above the revenue that they get from lending, right? So it's an
yeah,
asset liability mismatch that makes banks stop lending, and that's typically what the signal is. And I'm kind of giving a simplified version, but inverted curves create credit crunches, and then the economy stops and you get a recession. So what's
yeah,
different this time? One is that a large swath of the economy, homeowners, corporates, refinanced their debt in 2020, 2021 at very low rates. A lot of people are sitting on a 3% mortgage termed out to 30 years, and they're not going to
yeah.
sell that house unless they have to.
Yes,
Corporates did the same thing. And so a lot of people and companies termed out their debt at low rates, and that makes them less vulnerable to a rising cost of capital, which of course is what the Fed is creating when it's raising rates. The other one is that, and again, I don't mean to paint banks with a broad brush here, but the overall banking system, with the exception of maybe smaller banks that suffered deposit flight in the aftermath of the Silicon Valley bank crisis and First Republic back in March of last year, and that are maybe suffering from commercial real estate losses. But by and large, the banking system still has a very low cost of funding, right? If you think about how a bank lends money, they are lending out the deposits that they have from people like
yes.
you and me. Well, guess what the average deposit rate is on banks in the U.S.?
If I had to guess, 4%
It's
optimistically.
0.5%.
Oh my
So
goodness.
the Fed funds rate is 10 times higher than what the typical depositor gets at a bank, especially the mega banks. So when
That's
you're a
why is it
bank,
so low? Sorry to interrupt, Jurrien. Why is it so low? Is it just checking versus savings, or
uh,
what's going on?
so because they can. Obviously, as consumers, we have the option of buying a CD or buying T-bills, investing in a
Mhm.
money market fund. And again, not all banks are doing this, but the average deposit rate is 0.5. And that's because, like if there's money that we have in the bank that, we need to pay rent or buy groceries,
Yeah,
we're not going to be moving that around on a daily basis. Like, okay, I can get five here. It's sort of just, it's sitting there
yeah,
as a convenience. Um, but if you're a bank and you're lending money and your cost of money is 0.5%, you're not feeling any of this yield curve stuff. And again, I
yeah.
think that's a mitigating circumstance. That doesn't mean the
And therefore, you don't
inverted
stop
curve will
lending. Yeah,
never work, that it won't have some effect at some point. But I think these are circumstances that are making it um, less dangerous. Maybe the bark is worse than the bite at this point.
yeah. Okay, that's really interesting. I hadn't realized about the deposit rates. I think sitting in the UK, our our retail banks are paying somewhere between 3 and 4%, and if you're a challenger like a Marcus by Goldman or those Chase in the UK, you're getting towards 5% in some cases. So yeah, that's just my warped perspective on retail
Yeah,
banks.
and it should be 5% because historically deposit rates follow short-term rates with a lag, right? The
Yeah,
banks are always slow to raise rates when the Fed is tightening. They're very quick to lower rates when the Fed is easing, but they're slow to raise rates. But in this particular cycle, the difference is really large. Yeah.
exactly. Okay, let's move around the world a little bit, or maybe not, because I guess the question here is to give the UK as an example. We've had the country exit recession. We've had a slight uptick in the unemployment rate. Uh, Expectations for the Bank of England to increase rate cuts have been, ratcheting up. You know, the ECB and their rate increase dynamics have been sort of ongoing. Uh, I guess the question there is, you know, how are you thinking about Europe and the UK in the context of uh, the global macro picture? And maybe a secondary question is, again, certainly for the UK, does the UK again really matter in this context, or do we all as investors, should we be setting our clock by the US and then everything else sort of is a derivative from there?
Well, I think the rest of the world, so ex-US, has a stronger easing bias or is already easing policy. And in part, actually, it relates to what we just discussed about mortgages, in the UK, in
Yeah,
the continental Europe, in Canada, other places, the 30-year fixed rate mortgage is not as well known as it is in the US. And if you look at the vintages of mortgages in the US, that was a very clear switch from variable rate to fixed rate around 2020, 2021. So US consumers
yeah,
were very smart to term that out. It's like, you know what, I don't know if I'm ever going to see 2.5% again on mortgages.
yeah,
And so I think central banks in other parts of the world, those economies might not be as resilient for that reason. And
yeah,
therefore, the bias to ease is going to be stronger. And the US can afford to sort of be the last central bank to cut rates rather than the first one. And that has
yeah,
implications for obviously the business cycle, but also for the dollar. I think that's one of the reasons the dollar has been strong, and that, of course, is relevant for global asset allocators.
yeah,
So I do think that there is a divergence there that's going on, and of course, Japan is sort of in its own world as well.
yeah,
And
yeah,
the U.S. has this unique thing where we have monetary restrictive, a restrictive monetary policy, and a very loose fiscal policy. And
yes,
normally, if you had really loose fiscal policy, you would see the currency weaken. Uh, but combined with restrictive monetary policy, it's actually strengthening the currency because it's attracting capital, A, because the economy is strong, and B, because interest rates are high. So, and that's why I think we saw just in the last week or two, we had the softish payroll number earlier
Yeah.
in the month. And then we had the CPI, which, thankfully did not surprise in the wrong direction. It wasn't even that great a number, but after several months in a row of hot inflation prints, obviously the market and the Fed probably breathed a sigh of relief. But that 1-2 punch, allowed the 2-year yield to come down, allowed expectations for the Fed to get more optimistic, and immediately you got sort of like a reflation trade, right? The dollar went down. The dollar follows the 2-year yield in lockstep, pretty much. So the dollar weakened a little bit. EM kind of caught fire. Emerging markets, commodities are sort of moving again. And that is the kind of the classic, what we call the reflation trade that we saw a number of times after the financial crisis, when the Fed sort of capitulated on trying to lift rates off the zero bound, or when it capitulated from doing quantitative tightening and maybe doing QE2 or QE3, you got exactly that reflation trade. And that's what we're seeing. And it just shows you how sensitive the global markets are to what the Fed is doing. So the Fed really, in many ways, is the world's central banker.
Absolutely. And you mentioned the reflation trade on the commodities side, maybe China potentially at play there as well, with its own fiscal stimulus, which we might come on to if we have some time. But Jurrien, so you look at macro, you look multi-asset, you're a thought leader. Week to week, you share your sort of multi-asset views along with some interesting charts on LinkedIn, part of which is why we thought you'd be such a great guest for the podcast. How do you put it all together? We know how important asset allocation is, and it's a massive driver of returns over and above individual security selection. So, when you're sitting down with your teams, with investors, with clients, what is that holistic view at the moment? How do you put this all together?
Yeah, so I like the term you use, because it is holistic. I mean, it's part science, part art, right? Like a discounted cash flow model is an equation, but how you think about the assumptions that go into the equation, is in part an art, right? And one of the, not to pick on the DCF model, but it's both a most elegant and frustrating tool, because it's elegant because everything that's happening in the market you can explain through a DCF, right? Earnings growth, the risk-free rate, the risk premium, which is kind of like a sentiment indicator, and that makes it a beautiful thing. But it has so many variables that it's like you can't solve for 4 variables at the same time, right? So you have to lock some in while solving for others, and then you have to make assumptions. And that, to your question, that's always the tricky part. You cannot get around any of this without making some assumptions about the context, whether it's the secular context or the interest rate context. And Fidelity we have an incredible team of macro portfolio managers, but also obviously stock pickers. We have hundreds of analysts. Sorry, that's my doorbell. And weaving that mosaic together, right? Like hearing from our analysts about what's happening in AI, and they're meeting with these with these companies, and then speaking to the person who runs our bond portfolio, and the person who's in the high yield market, who's looking at convertibles. And so it is a mosaic, and in part it also requires just experience from cycles. I mean, I've been at Fidelity 29 years. I've been in the industry 39 years. And so I've seen many cycles, right? And no cycle repeats, of course, but we might be in a cycle and I'm like, what, that reminds me of 94 when Greenspan raised rates, and then he kind of the maestro created a soft landing, and then market rallied 37% in 95. And it's never going to repeat exactly, but borrowing from history to learn about, okay, a little bit of this kind of synchronizes with that and that, and so it is a creative process, even though
Mm.
the indicators and the metrics are more scientific. And my particular creative process, and I think it's important for everyone to have one that makes sense to them. But what
Yeah.
I have a very sort of nonlinear schedule. So, my kids are older, they're in 20. So like my weekends are kind of mine to use however I want.
The
And
dream.
so every Saturday I do this massive download of basically, 3 or 4 decades worth of indicators that I've amassed, and they're all sitting in Excel spreadsheets. And I
Mm.
just go one by one, and I'm like, okay, this chart doesn't tell a story, but this one tells a story. And I just go through it, and it's sort of like transcribing documents. You're kind of like, it goes into your head. And then by the end
Yeah.
of a Saturday or Sunday morning, I'll have 20 or 30 charts that I feel are telling the narrative of what's going on. And then on Sunday, I write, and that's what you then see on LinkedIn on Monday, and it goes to all my colleagues on Sunday night. And it's a creative process that's part art and part science. And I see myself as a storyteller basically, and there's a lot of stuff going on. The noise to signal ratio is very high
Yeah.
these days, right? You go on X or LinkedIn or anywhere else. There's a lot of stuff to consume, and not all of it matters. Actually, most of it probably doesn't matter. And so I try to help my colleagues who are running multi-asset portfolios or individual equity or fixed income portfolios, as well as our customers. I think Fidelity,
Yeah.
at last count, has 50 million customers. And so I
Wow.
try to help them understand what they need to focus on in order to make well-informed investment decisions. And so that's kind of how this funnel works.
Fantastic. That's a fantastic mission. I think I'd, maybe just to pull back on one point you made on the DCF, just to tell a bit of a story there, because I I completely agree with what you said about the science and the art of a DCF, and I think where I come down on it is perhaps more cynical, and simply because as a sell side research analyst, I love the DCF because of its precision, and you could say to the cent uh, what you believed a stock was worth. Um, that got flipped on its head when the bankers would get a hold of my model and be able to say, to a cent, what they think a stock is worth or what they think the acquisition price would be. And you sort of start to realize, okay, well, yes, it takes multiple people to make a market, but if a DCF can be bent to the will of its owner so easily, then having it as the be all and end all perhaps isn't necessarily what you want to do.
No,
But
it's very true. And there's an old saying that if you torture the data long enough, it will confess to anything, right? And so
yeah,
the DCF is only as good as the assumptions that you make.
exactly.
And if you plug in, like your standard DCF model, you'll put in a 5-year rate of change for earnings, for
Mm,
instance. Well,
yeah.
like that's backward looking, right? So you have to make some predictions about future earnings, which of course our equity analysts will do if they're looking at a company and they think, wow, this is going to grow earnings 20% for the next 5 years. I mean, that
Mm,
is the whole basis on which to make an investment thesis. But what I tend to do is, I look at the long-term earnings growth rate for the S&P, 6-7%. Um,
yeah.
the DCF is by definition a long-term model for a long duration asset. So I'm just going to plug in 6% for earnings. I'm going to plug in
Yeah.
the average for the payout ratio, which is about 75%. And I really just solve for the risk premium. And the risk
Gotcha.
premium, the realized risk premium historically is around 5%. So equities generate a 5% greater return than bonds, than the
Mm-hmm.
risk-free asset. And I plug in, the current interest rate, that 6% earnings, 75% payout, and it spits out what the equity risk premium is, currently the implied risk premium in order to explain the current price of the S&P. And then you look at, okay, the ERP is now 3.5%. Historically, it's 5. Is that a problem? So that's kind of how I try to get the signal out of the noise.
Exactly. I think that's exactly it. I think from my point, again, you're coming at it from a macro point of view, top down makes a lot of sense. If I'm thinking about it bottom up, what I am never trying to do with a DCF is tell an investor what their return should be. So I don't take a view on the the equity risk premium. If you want 20% premium from an asset, that that's on you as the investor. I'm just saying, look, this is how I'm thinking about it, and then over to you to do with it what you will. But yeah, I think we're certainly aligned on that. And it's interesting you talked about your process for writing, bringing it all together, publishing on a Sunday night. The industry's changed certainly over your 29 years at Fidelity, 39 years overall. How much of a USP in your role is the LinkedIn posting? Is it table stakes at this point? Is it obviously within Fidelity you've got your stakeholders there, but what's that dynamic like these days? And when you speak to investors within the firm, investors outside, what's that? What's that edge that you have from posting on LinkedIn? What do you think?
It's a great question, and the industry certainly has evolved. Like in some ways, we're doing exactly the same thing as we did when I was hired 30 years ago. We're trying to pick the best stocks or the best bonds. Our underlying, single asset products, like an equity fund, a fixed income fund, a high yield fund, they generally don't make macro calls. We have some very large funds who just don't have the luxury of making tactical decisions. If you buy a stock, it might take you a year to buy it, and you certainly don't want to sell it a month later, right? So, and so in that sense, what I do, I think, is helpful as context in terms of understanding the relationship of interest rates to the stock market, right? And in some sectors, that's more relevant than others. If you're running a utility stock sleeve, what happens to interest rates is very important. If you're in an aggressive growth fund, it matters less. If you're in a real estate fund, it matters more. Obviously, what monetary policy means, the relationship of earnings growth and valuation. So for some single asset portfolio managers, my work is something that's interesting to read, but it's not necessarily going to make them change what they do. But we have, within Fidelity, we have a multi-asset group that's, and then we have what's called SAI, which is our investment advisor group that does so that takes advantage of the single asset fund. So it's like they're building blocks. So that weaves itself into all of our products, but they also have to make top-down asset allocation decisions, right? How much in stocks, how much in bonds? Do we buy some commodities, or do we do this? Do we go outside the U.S. in emerging markets, et cetera? And for those folks, and this is well over $1 trillion of assets, I'm more of a thought leader in terms of, how to think about, not falling into the valuation trap of saying, EM is at 14x earnings, the U.S. is at 21. Should I therefore buy EM? And I'll do some historical work saying, well, relative performance follows relative earnings, and that valuation might be tempting, but without a catalyst on earnings, you may not get there. And why are the earnings then greater in the U.S.? Then I go into what I call the Nifty 50. We talk about the Magnificent Seven. Well, that phenomenon has been around for decades. And the original episode was the Nifty 50 in the early 70s. And then you had the mega cap cap tech in the late 90s, and now we have another iteration of it. And so then I'll do a study on, okay, what did these three episodes have in common? How is this one different? And so that kind of historical work of delving into market history to try to learn from the past, even though it doesn't necessarily repeat. I think that is generally helpful to everyone, or at least that's the intent. And whether a consumer of my work can take it and really like implement it in some direct way, or whether it's just helpful to know as context, that kind of runs the spectrum. But that's within Fidelity. Outside of Fidelity, when we talk to our customers, we really just want them to make informed and unemotional investment decisions, not get swept up by whatever is happening today. And so, one of my favorite things to do is when the market's down, 5 or 10%, like the impulse is for people to freak out and say, you know what, why don't I sell now and ask questions later? And then I'll bring out my chart saying that a 5% correction happens 65% of the time, and therefore the compounding doesn't work for you if you're on the sidelines. And so they're almost like financial literacy type of things to make sure that our investors do the right things for them and not get whipsawed by the markets.
Absolutely. I think your approach is far greater than my impulse, which is to say there are more sellers than buyers, as a simple explanation for why things are down. But I'd also give you a bit more credit than you're giving yourself there in terms of looking at history as a guide, because you say history doesn't repeat itself. I would perhaps argue that history would repeat itself if not for the analysis you're doing to indicate what might lie ahead, and therefore now we're getting into the butterfly effect and kind of circular time travel. But I think the point stands. So what makes a good investor, Jurrien?
That's a good question. One that does not make emotional decisions. I think that our emotions can be our worst enemy. It's behavioral finance, right? Like loss aversion is a more powerful emotion than return seeking, for lack of a better word. And so knowing the market math, market goes up 60, 70% of the time. You get, if you wait long enough, you get about a 10, 11% return in the stock market. But the price to be paid for that return is gut-wrenching volatility, and the market will go down 20 or 30% from time to time. But understanding and appreciating the magic of compounding, the eighth wonder of the world, and understanding the math and understanding what it means to have a diversified portfolio where you don't get too greedy, that you have your eggs in one basket, but you don't get so fearful that the compounding doesn't work for you. I think just having that balance of, if we think about an efficient frontier chart, right, that curved line going from lower left to upper right, being above that line, being as far to the left of that chart and as far above that line as possible, that's the goal. And of course, our folks who deal directly with customers, I mean, it's their job to take the input from our investors. What are your goals? What are you solving? What outcome are you solving for? And what is your risk tolerance? And then finding the optimal point on that chart. It's I always get asked when I'm on TV, and if the market's down, they always ask me, Jurrien, what should investors do right now? And I always say the same thing. It's like, have a plan, stick with the plan, and use volatility to rebalance. But the sticking with the plan, having a plan is one thing, right? You can optimize, okay, this is the perfect portfolio, but then sticking with the plan can be very challenging when the market comes down.
Of course.
And then, of course, the tricky part is, even with having a plan, even if it's never simple, but even if that's relatively simple, having a plan is dependent on relationships between asset classes persisting, right? I mean, what is the role of bonds in a portfolio, in a 60/40 portfolio? It's different now than it was 3 years ago, right? Bonds are now
Yeah.
positively correlated, but they offer a real yield, which they didn't do 4 years ago, but they were
Yes.
negatively correlated. And so understanding the changing nature of inter-asset class dynamics, and that's, again, it's something that we try to do because the average investor may not appreciate those nuances, but that's our job then to educate.
Fantastic. Really clear. And, we've touched on it already, almost a 40-year career and counting. You're going to have, over that time, you'll have had some good bosses, some bad bosses. You may have even been both of those yourself. So what do you think makes a good leader?
A good leader, I think, a good leader serves the mission, whatever the mission is, and thinks about the mission more so than what their needs are. And I don't know if that makes sense, but I'll give you a completely unrelated example. I run a food camp at Burning Man, of all things.
Oh wow! How do I get a ticket?
and our camp has a mission, which is to feed the artist. We're literally called Feed the Artist, and we go to Burning Man because the art is a very important part. And these people are working 16 hours a day in the hot sun to create their art, and we go out and we feed them. And there are times when, for instance, right now, not now, but like in January, February, where we're ramping up to do this yet again. There are times when why do I keep doing this? And it's like, okay, it's the mission. We're doing something really important in that little microcosm of the world. And a Fidelity leader, I think, will think of it the same way. We have a mission to service our customers, to help them solve for their investment outcomes, for whatever the purpose is, and just taking this, transcending your own personal situation and making this about the mission. I think you're always going to stay on the right side of the decision-making process if you do that. And so I think that's what makes a great leader. And I think, just the ability to reinvent yourself. Like, I don't really consider myself a leader. I don't have like a team of people working for me, but I've had to reinvent myself a few times in my 29-year career. I've had many bosses. I think I've had like 15 bosses in that time. And people are, they're moved around, and with the mobility is part of our culture, and just sticking to that mission. And if something changes, being flexible and willing to change with it, because change is always afoot, of course.
Thank you for sharing that. So we're almost at the end, Jurrien. But before I let you go, I wanted to touch on our lightning round. So 4, 5 short, sharp questions. Let's take it out of work. Let's take it away from markets, just about you, your life, and things that have happened. So please tell me, what was your first investment?
My first investment? Oh my God. I think it was just an equity fund when I started a 401k back in the earlier days when those were created. I don't really remember what it was, but it must have been a fund because that was on the menu at the time.
Fair enough. Okay. What was your worst investment, if you can remember?
My worst investment. Whatever it was an emotional one.
Fair. Yeah. Do you remember your best investment?
I think probably, as a long-term investment, Fidelity employee, I participate in the profitability of the company, and I would say that's probably been my best investment ever.
Fantastic. Is there any investor out there that you really admire, that you admire the most?
There are many, but the ones that are flexible, like the strategist or portfolio managers that I find are the best are the ones that stay with their discipline and are not perma bears or perma bulls that no matter what they're going to say, you have a sense that you know what they're going to say. And to me, those types are not really helpful to my investment process. But the ones that are saying, that have a consistent approach, and whatever the outcome is what the input says it should be. That it requires humility, and so I would say probably the biggest attribute I would look for in a portfolio manager, an analyst, or any person is even really, really, really smart ones is humility. Because without humility, I don't really have time for you.
Fantastic. I'd almost add that to your previous answer about what makes a good investor, as well as being unemotional. And is there any advice that you can give to our listeners that you wish someone gave you at the beginning of your career, or back when you made that first 401k investment?
I would say make sure you have balance. Investing is kind of a left brain pursuit, right? And I've been in this industry for a long time, and it tends to be a left brain industry. It's about numbers and PE ratios. I would say, advice to a younger me would be make sure you complement all that left brain analytical work with some right brain stuff, and like my biggest hobby is cooking. And every night, even if I'm by myself, I'll spend 2 hours in the kitchen cooking myself a meal that I will then eat in 5 minutes. But that process, is very therapeutic, and it's a mindfulness process that I think is a good way to anchor ourselves and not become unbalanced when we're pursuing too much on one side.
Yeah, I suspect that Burning Man, even if you're feeding the artists, is also quite a fun right brain activity too.
Yes.
And last but by no means least, Jurrien, please tell us where people can find out more about you, about Fidelity, and everything that's going on there.
So probably the easiest ways to find me is in social media. So I'm on X. The handle is @TimmerFidelity. And then on LinkedIn, I'm there. I think I'm the only Jurrien Timmer on LinkedIn. So if you just search for me, you'll find me. And I make a lot of charts. That's sort of my creative outlet, if you will. They have lots of colors in them. They can be a little busy sometimes, but I like for my charts to tell a story. And so you can find pretty much all of my stuff on those two outlets.
Fantastic. Jurrien Timmer, learned a lot. I'm sure our listeners and viewers have too. So thank you once again for joining the Finimize podcast.
Great. Thank you very much.